it can feel overwhelming.
We've told the consumer to be both the patient and the doctor when it comes to managing their money. So who wouldn't be overwhelmed?
Hey everyone, I'm Josh. This is the In Your Corner podcast from CBS News Philadelphia, where we are all about finding you practical ways to make smarter financial decisions. And a good place to start is by taking stock of your stocks. A new year is always a nice time to review your investing strategy. So before we get too far into 2026, could your portfolio use a little love? How do you protect yourself, right? How do you stay consistent, especially with a lot of uncertainty that remains in this market right now, especially around artificial intelligence? Someone who is a lot smarter than I am is here to help us answer all of those questions. Mical Jeanlys-White, founder and CEO of WealthMore, a financial planning app that's designed to help close the wealth gap by making expert financial advice more accessible and affordable to all. Good to have you back.
Thank you, Josh. It's great to be back.
You've had a busy few months since we last saw you.
Yeah, we have been very busy.
It's been really fun to watch the growth that you guys have had since we first met last year. And I know, you've been putting in the work long before that. So let's dive in, right?
Let's go right in.
Because if you're a daily connoisseur of the news, as I am,
It's probably not good for your investment strategy.
or my mental health, but that's another podcast entirely. Look, putting kind of a quick bow on last year, because last year felt crazy as it was coming out of that. So now that you've had some time to reflect on kind of where we ended things last year in the market since our last conversation, where do we stand? Because I feel like there is still a chasm.
Yeah, we can't ignore last year because last year was so unprecedented. And I like to say if you can invest last year, you can invest any year because we started March with a lot of noise around tariffs, and that sort of carried us through the year. We had not just tariffs, we had tons of inflation news, job losses, and yet the market still did very, very well. So, as a consumer and as an investor, you have to separate the headlines from the actual fundamentals and understand that the stock market is over 5,000 different stocks, many of which are things that you buy every day. So, regardless of the headlines, you're still buying things. You still need your daily items, you still need your groceries, you still need your utilities, and they are all part of the stock market. And that's how you get to diversification, and that's how you see such strong returns despite the headlines.
Right, because whether it's you're talking about the Fed, whether you're talking about tariffs, the list goes on and on. Day to day, it feels like, whoa.
Yeah. Yeah. I obviously in this space, so I, like you, take in all this investment news, but I'm also taking it in as a informed professional looking at the fundamentals. But I can empathize that as a consumer or an everyday investor, it may feel like the sky is falling in, but we had a strong rebound, right? The market, just take the S&P 500 from a low that dipped by recovered by 75% from the dips that we saw in April.
Well, the last time you were here, you brought some helpful charts
Yes.
to illustrate the fact that every time it's gone down, it comes back up and then it goes up even
Yes.
further. You got more charts, I think.
I
This time.
sure do. I love them, right? So
Yes.
let's just go through the list, right?
All
Let's
right.
look at 2025, right? And for those of you who saw the market dip dramatically after Liberation Day and felt like, will the market even do better than a high yield savings account? So if you were going in and saying, hey, I'm taking my money out of the market and putting into a high yield savings account, which may have given you what, 3.5%.
Mm-hmm.
Now let's compare this. Mag 7 ended the year at 24.9%.
Real quick, Mag 7.
These are the top tech stocks. So
Okay.
think Alphabet, which is Google, think
NVIDIA.
Meta, Nvidia,
Okay.
Tesla, Amazon. These are Microsoft. These are the stocks that make up the Mag 7. They're also the ones that are creating so much of the AI bubble. So we'll get to that.
That's next. Yes. So wait. So high yield savings account give you about a 3.5% return, and you said what was the Mag 7 giving us?
24.9.
Wow. Okay.
Massive. Now you might say, okay, well, what's next? NASDAQ Composite, 21.2.
Massive still.
A lot of tech stocks in there as
Yes.
well. NASDAQ 100, 21%.
Okay.
S&P 500, which I know you guys are told all day long, just buy the S&P 500,
Mm-hmm.
17.9%.
Still great.
So now I'm going to go down to the Dow, which is more the staples that we talked about. Dow, 14.9%.
Okay.
And then I'll go down to like things like the mid caps, which are still sort of like just about everything. Smaller, mid-sized firms, still 7.5%.
So the lesson here is
Be an informed investor. Stay invested. It is still, for the U.S. investor, the best market to be in.
so even, and I feel like a broken record sometimes, like you're beating a dead horse. But to your point, every time we have one of these days where everything's in red,
Yeah,
they go, Josh, get in front of a camera at 5 o'clock. What does this mean for
yeah.
everyone? And I always say, thanks to advice from people like you, don't do anything at the moment.
Don't be emotional.
Yes.
Do not just say, let me log into my account and sell everything. We had our own clients who were calling us in saying, I'm near retirement. I can't handle this. I want all my money out. But they had an advisor to come talk to and walk through just how much exposure they really had and what other options existed. Right? I would not tell someone who's near retirement to be in our aggressive growth portfolio.
Sure.
But conservative growth portfolios still, by and large, outperform things like treasury bills and high yield savings accounts.
So stay invested.
Stay invested, but speak to an
Mm-hmm.
informed, certified financial planner to get that advice to look at your own individual financial picture.
And how you're kind of spread out
Yeah,
over
yeah.
everything, right?
This is a numbers game, right? So when you start looking, and we talked about this the last time I was here, the news versus the actual numbers can
Mm-hmm.
be just the emotional reaction is so different from the actual data. So when people hear the market's pulling back, it's generally again 1 to 3%.
Mm-hmm.
But people hear that and they hear 90%.
Sure.
That's the emotion
Sure.
they feel.
Sure.
So important to talk to an advisor who can dimension that, who can bring you back to the fundamentals.
Mm-hmm. And also like the emotion from the people who are there trading the stocks, right?
Yes.
It's all the human element in all of this.
I'm so glad you
Yes.
mentioned that because I think it's super important to differentiate the folks that are talking and sort of, hosting the shows, right?
Sure.
Many of those individuals are paid to outperform the markets. They're chasing alpha. It is a very, very different headset than the everyday consumer investor who's looking to just build long-term growth, right? They have promised someone that I'm going to do better than the market in exchange for, let's say, 3%
Mm.
returns. They have a different job to do. So
Mm-hmm.
you cannot react to someone who's doing a very different job and objective than your own.
Yeah, I'm just worried about my 401k here.
Yeah, you're worried about you didn't promise someone like you could outperform the S&P 500 and the Mag 7.
Sure. Yeah, talking about like a commentator on one of these financial shows or
It's
something
very
like that.
different.
Yes. Okay, that's good. Now, you say that though in terms of staying invested, staying calm, but we continue to hear about when is the bubble going to burst
Yeah.
around artificial intelligence? And you talked about, the Mag 7 and how well they
Yes.
perform, but a lot of that
Yes.
is tech, a lot of that is tied up
Yes.
in what's happening right now with artificial intelligence. So I still feel uneasy.
Yeah, because what you're hearing about the bubble is because you have the Mag 7 highly concentrated in an AI bet. That AI is going to play a meaningful role in making companies more efficient, bringing down the head count and the human cost of
Mm-hmm.
getting work done, which for most companies is like the biggest cost item. So they're making that big bet, but none of them are taking a contrarian view. So they're all saying, yes, we're all in and putting billions against it. So if they're all wrong, they will move together. And they are driving 50% of the returns in the S&P and the NASDAQ.
Okay.
That is why people are so concerned. So I'll give you guys a comparison. Imagine that you had invested in all luxury resorts and travel stocks, and then COVID happened.
No bueno. Yeah, not good.
That is what people are afraid of. And that's where the diversification matters. You do not have to have all of your eggs in the Mag 7.
Simple as that.
Simple as that.
So, sure, don't ignore it. Be scared to go away from it, but
Yeah.
don't go all in either.
You got it. This is where diversification matters, like even more.
Mhm.
When you have this sort of novel technology, similar to, and you'll hear people mention the .com sort
Sure.
of bubble, again, novel technology, not quite sure yet what the impact will have on the markets. Still plenty of question marks, but billions, trillions are being placed on this technology without necessarily the returns or the revenue yet, right? It's a growth stock, it's a speculative play.
Mhm.
So if you're putting all of your investment dollars or too many of them, then you're either riding that wave, and if it's right, you'll probably see outsized returns, but if it's wrong, you'll see outsized losses as well. Now, if you're like, hey, that's where I am in my investment cycle, that's fine. But if you are like most people, and we see it even at WealthMore, most people are in that sort of middle in term of risk. That's where the diversification makes a huge difference.
Where even if we do see some kind of bubble burst, sure, you will be impacted, but it won't be anything where you can't climb back in a reasonable amount of time.
Absolutely. Absolutely. It goes again to that emotional when we hear correct, so let's say market crash, right? That's
Mhm.
generally a 20% or more. But we are not generally talking about 90%. These are still large companies that have other services, products that they offer that they have been offering and being super profitable doing so well before AI came into play.
Okay, so
Those fundamentals don't change. You're still going to use an iPhone. You're
very
still going to
true.
Google.
Very true. I still need my Microsoft Word, even if, right? Yeah.
Okay? Those
Yeah.
things don't change.
Yeah.
We
Okay.
still need our microconductors. We still need all these different things that, it's the sensor that when you're backing up your car and it goes beep beep. Those are all some of the things that, these different companies make.
There is power too, and again, just sort of the consistency of it all, right?
Yeah.
With what you're doing and how you're approaching and reacting
Yeah.
to what's happening.
Yeah. And I am very empathetic, right? I used to invest on my own, right? I would have these very sort of watching the market and sort of worrying and logging to all my accounts and doing it on my own. And now I have a wealth advisor and we have a chief investment officer, and that's his job. You deal with it
Yeah.
and make the right investment decisions
Hmm.
and give me that peace of mind so I can go off and do the everyday stuff.
It's interesting. I was just having this conversation with a good friend of mine who I think I've mentioned several times on this podcast because he's helped me tremendously in terms of financial planning, and I've been dumping a lot of extra money into my high yield savings
Yeah.
account because I love a high yield
Yeah.
savings account, right? We love that. I try to tout them whenever we can.
Yeah.
But to your point, he goes, well, do you think maybe, I mean, you got a decent amount. Maybe you
Yeah.
start diverting that to your brokerage account instead, because guess what the return was last year? And
Yeah.
I thought, oh,
Yes.
mm,
High yield
good point.
savings account
Yeah,
is the perfect vehicle for your rainy day emergency fund or anything that you're saving or that you need that cash within the next 1 to 3 years. So if
sure.
you're like you saving for a home, perfect
Still
place for
saving.
it.
Yeah,
Perfect place for it.
yeah.
Long-term investing, if that's your strategy, then you have to be comfortable with a 3% return.
But again, and I guess in terms of long term versus short term,
When we say long term, we're generally speaking about 10 to 15 years of investing journey. So when we're thinking those strategies, those are for that cash that you are not looking to sort of pull out anytime soon. It's for your long term growth. But let's double click on the high yield. Inflation is at 3. We ended the year at about 3.5% inflation.
mhm,
That means your returns on that high yield savings account are not outpacing the value of your dollar,
mhm.
right?
Yeah,
Things are getting more expensive, but your money is not outpacing the pace of inflation. You generally want your money to be outpacing the pace of inflation, which is why we always want low inflation as well.
You're not saying high yield savings accounts don't use them, right?
No, no,
But
never.
what's the kind of the break
Yeah.
even point, I
They are
guess.
the perfect vehicle for your emergency fund. So let's say 3 to 6 months of your living expenses. So if
Mhm.
you were to lose your job or be in between jobs, that is the role of the emergency day fund, if you will, rainy day fund. And a high yield savings account is a great vehicle for that. Beyond that, we'd like you to be investing your surplus income.
So once you feel like you've got a comfortable enough pad there,
Yes. And that varies.
sure.
I can tell you, I think I told you this story, but early on, for me, my personal comfort felt more like 12 months. And when I started talking to a planner, they're like, oh, it's a lot of comfort. But it
I like to be
varies,
comfortable.
right?
Yeah, yeah.
It's what gives you peace of mind. And so I won't tell you definitively one way or another because there's no judgment here, but realize that that is doing a very different job than the money that you put to work to invest and to hopefully do better than inflation.
Look, I always tell people too, it's like some of this stuff, I get that it's not maybe the sexiest stuff, but this is the stuff that bears repeating. This is the stuff
Yeah.
that is going to move the needle for you over time by
Yeah.
just staying consistent, staying kind of boring,
Yeah. Yeah.
right?
And informed, just
And informed.
understanding like the math behind it. And I always use math because I think all of this is really a numbers game, right? How much you earn, how much you spend, how much you save, what's the return you're getting on those dollars saved. So when you just sort of sit back and look at the numbers of it, hopefully that brings people a bit of peace of mind, unless you're one of the people that hate math.
Well, I'm not the best at it, that's for sure. But, and this goes back to having a budget,
Yes.
to knowing very basic in and out each month,
Yes.
because otherwise you don't know even what you have left
You
to
have to
save.
budget.
And
You have
actually,
to
to your point, you shouldn't wait until the end of what you have left to
take it
figure
off
out
the top.
what you're going to save. Thank you. I can't bear repeating this
It's
enough.
so much easier,
Yeah,
at least for me,
yeah.
because then I don't have to do all the line items. If I know I have just at the onset put aside the money for saving and investing and then live life with what's left, makes it a lot easier.
This year has felt like already several years just in this past month or so.
Yeah.
um, what is your feeling as we've started the new year in terms of where the markets are
Yeah.
and kind of where we're headed?
Yeah. The US consumer is strong. That is good news. And while I still struggle with the definition of what it means for the US consumer to be strong, because I would put a different definition on strong,
Hmm.
but by the standard in which we assess it as a market, the consumer is spending, the consumer unemployment, though the numbers are creeping, we're still at like reasonable unemployment, and inflation more than likely will continue to see cuts and rein inflation in. So those are positive things. We're in earnings season, and a number of the firms that are reporting are reporting strong earnings. That's also good news and a reflection on the consumer doing well, which generally means that as the consumer does well, corporate earnings are doing well. You should see that performance reflected in the stocks that you invest in.
What's your definition of strong?
I would like, I don't believe, gosh, we're going into a really interesting territory here,
Do we
right?
want to go there? Yeah.
Um, my definition of strong would be that instead of hearing things like the average American can't produce $500 in an emergency, and yet we still say the consumer is strong, that we would be able to say the average American has thousands in savings and thousands in investing. Those would be numbers that would warm my heart for the average American.
Well, you know what? I mean, that's such a good point that you make because, yes, so often we talk about, well, actually, on paper, things look great, things are trucking along.
Yeah,
And then we have those reports where, people wouldn't be able to, if they had an emergency of
yeah,
$1,000 or more, they'd go into debt.
yeah.
So, it's like, how do you square those two?
Yeah, I think you and I have riffed about this a bit. Is that the economy being strong is a different measure in terms of inflation and unemployment versus if we had a different definition or a different goalpost for the outlook for the average American.
For what it
right?
means, yeah, every day out of your
Yeah.
wallet, right?
Yeah. Or just, how the average consumer would define when they feel they're doing well, I think would be very different.
So stay the course.
Yes.
Stay the course and
Get good advice.
get good advice,
Get good
which is exactly what
advice.
WealthMore is all about.
Yeah. And remember the whole importance of diversification, especially in markets like this.
So that you can weather when we
Yeah.
do have storms, because we're going to have storms.
Just part of investing, right? This is
Mhm.
again why it's the long term and why the market, no one says the market will perform 20+% every year. What we've looked at is that over the long term, we've seen the market do 10% or more.
It helps when someone like you can come in and lay it out in a way that's simple, because I think, again, the biggest hurdle for so many people is that it can feel overwhelming
Yeah,
sometimes.
yeah, yeah. And I can fully empathize with that because, I've shared this with you before. We've told the consumer to be both the patient and the doctor when it comes to managing their money. So who wouldn't be overwhelmed?
Because it's so true, right?
Yeah.
You shouldn't be the one that's also helping to diagnose and care for yourself.
You dropped me in a medical facility right now and told me do it, I'd be like,
We ain't getting out of here. Yeah.
no, right? But that's sort of the situation we've left 100 million Americans in, which is figure it out, and then the sort of very flippant, just buy an ETF or buy the S&P 500. But we know that is actually not accurate, not given how the Mag 7 have grown over time, and they represent over 50% of the returns. So there's massive concentration risks around big tech.
McCall, thanks so much for coming in today.
Thanks for having me.
It always helps us just to kind of clear the waters a little bit.
Yeah, stay informed, stay invested, get advice.
Mical Jeanlys-White, she's the founder and CEO of WealthMore, a financial planning app designed to help close the wealth gap by making expert financial advice more accessible and affordable to all.
Thank you, Josh.